You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
And so what happens with unicorn deposits, they don't get bought once, they get bought several times. And so you get one crocodile new market, a small little transaction. You get $1 billion transaction plus for new market. You get a $9 billion transaction for Kirkland. Granted, Kirkland had more assets, but most of that was because of Fosterville. But if you knew before, or if I knew before how good that was, when I had new market and I made a win off of that, I would have kept Kirkland.
I'm Bill Powers, and you are listening to MSE. Thanks for tuning in, chatting today with Joe Mazumdar from ExplorationInsights.com. Joe, welcome back on to the show. You're back in Canada, but you were in Boca Raton, Florida for Rick Rule's annual symposium there in the summer. Can you give us a breakdown of sentiment? Did you learn anything there, and what was the sentiment overall of the conference?
Hey, Bill. Yeah, thanks for the invite. Yeah, I was in Boca, and it's like Florida in July is not great. I was there the week before for the Game 7 of the Stanley Cup final, which was only for a day. So I got a little bit of a taste of South Florida. Boca, I went to last year, and basically I had very low expectations for that conference last year. But what was good and what encouraged me to come back when I was invited to come back this year was really the audience. The audience, there's a lot of high net worth individuals that buy in the market. But you can definitely see the age group. It's definitely on the older side. And Florida's a good spot. No taxes, so they have more cash to spend. And the reaction of the companies there is, I know companies there that tend to not do a lot of conferences, and this one's not cheap. Do that one because when they talk to people there that come to their booths and that, they actually get buying, which is rare now in conferences. So, for me, they were doing a ranking under another guy, and a lot of people gave it a 9 or 10. I'm positive on it. I gave it an 8. Because I consider most conferences are probably more like a 5. It's definitely about the audience more so than maybe the companies that attend.
And your presentation was on artificial intelligence as it applies to the mining industry. And you're particularly interested in how that applies to resource estimates, right? More so than even defining exploration targets? Yeah.
So in Iran a couple of weeks ago, I introduced the concept of machine learning application to doing pre-resource companies. And so there's a guy named Aaron McMahon with a company called Tacit Vision. He's been working on this tool for a few years. He spent about 10 years with resource capital funds out of Denver. He's still based out of Denver. So he's built this tool up. I'm only using it for gold right now, but basically what it does is he feeds it all the data from a database with, I think, about 4,000 resource estimates, which are fed by, 4 or 5 million drill intersections, all public data. So we're not signing NDAs. We're not getting into anybody's, database, behind the wall or whatever. This is just straight data. So there are, problems with limits of data, but gold works really well because there's such a volume of data with gold resource estimates. As you go into markets that are smaller and smaller, the data will be less. And machine learning is all about data. So what you're training the machine to do is say, here's 4,000 different resource estimates. Take a look at them. And then if I give you these, knowing what you know as to what drilling conceptually gets you what in terms of tonnage and grade, model that probabilistically. And so what sort of got me onto it, we've been going back and forth for about 6 months before I started looking at the tools seriously, is that we looked at bad cases and good cases. So deposits, and this is where the human part comes in, is that, I have seen these deposits. So I know the ones that are on the fence, sort of marginal, that have problems, and the ones that I think are good. And so what I tried to do is see, okay, can I see that reflected in the result? And what's interesting, so we back did some. So what you see is all the data before that actual resource estimate that the machine would have got if it did it at that time, and then look at the resource estimate. What does it model? How predictive is it? So we did that for Fosterville. So Fosterville is a gold mine in Victoria. It started off as a heap leach a couple of decades ago, and then as it got deeper into the mine, it became sulfide refractory. Then they had to do bio-ox. So it was marginal grade, 4 to 5 grams, I think, and it was 80% recovery. So it wasn't making a lot of money at lower gold prices. And within the mine, they started finding these zones where the gold was free and associated with antimony or stibnite. And that was getting 97% recoveries, but the grade was like 20 grams plus. So the tonnage you didn't need a lot of tonnage to get a big impact. And so this was, for me, like one of these unicorn deposits, because you could see the immediate impact on costs and revenue. So revenue was driven by higher grade, lower tonnage, and higher recovery. So you got that, trifecta going. At the same time, because you're doing less tons, you got lower cost, and so the operating margin was going through the roof. And so that turned around Newmarket. And so what happens with unicorn deposits, they don't get bought once, they get bought several times. And so you get one Crocodile Newmarket, a small little transaction. You get $1 billion transaction plus for Newmarket. You get a $9 billion transaction for Kirkland. Granted, Kirkland had more assets, but most of that was because of Fosterville. But if you knew before, or if I knew before how good that was, when I had Newmarket and I made a win off of that, I would have kept Kirkland. And what the distribution of the results shows me is the grade was like 2 standard deviations above the normal grade for these deposits. So you know automatically that this is a unicorn. And then by seeing the deposit, its variability is very small once you could predict the structures that it was in. And as they got good at it, the variability was very low. And so it wasn't like a Brucejack where the variability is very high. It's high grade, but very low variability. And so that's another unicorn factor. But this model sort of gave me the impression that, I would have made a different decision. And so it's all about decisions under uncertainty. And so what would I have done with that information? For me, at that point, I would have kept half at least in Kirkland and done well. So that's one. And then I take another one, and I've done this with a few, but the interview is not this long, is I took another one that was not a good resource estimate, which was Phoenix, which was Rubicon. And so before the maiden resource, the distribution on that, and you could see from that, the grade that the resource came up with was not even in the distribution that the machine said. And so that's telling you that you've only got downside. So if you knew this and the resource came out, you'd probably sell because you knew that it was way beyond the distribution and it's highly unlikely that that's the number. And so that's another decision factor you could take to the bank and go, well, I'm selling because this is all downside. This is not a unicorn deposit. This is high variability and it's on the edge. It's beyond the edge of the distribution. So those are the sort of things that we could bring to the retail sector, and other people are interested in getting a quick idea, incorporated with other data. This tool by itself, you have to have more of a knowledge of the deposit to help you know which side of the distribution you should be on, understanding the geology, but you get an idea. Should I be worried about my downside or should I be really happy with my upside? That's what the tool is trying to tell you. And that's what we're incorporating into Exploration Insights going forward on some of these pre-resource plays, especially gold.
So this machine learning, like if you applied this to Victoria Gold's Eagle Mine with the heap leach collapse that we've seen in the Yukon, would there be anything predictive that this technology would have told you before they made the construction decision for that mine?
Well, this is only resource. So, on the variability of Victoria Gold, I don't know what the coefficient of variation is for that. I don't know how variable it is, but I know it's low grade. So if you have a highly variable deposit and it's low grade, then you really know you don't want to touch it because you're just barely getting to that low grade number. The problem with Victoria was more so in terms of the processing part. Was I think they got decent head grade reconciliation. The problem was the heap leach. So the heap leach was a fine crush. So it's about 12.5 millimeters, I believe. The original feasibility study, I think, wanted 6.5, but they did 12.5, I believe. And so it's fine. I don't think they used any cement, which is agglomeration. That would have added a bit more stability, and usually people use it because when it's fine, it's less stable. And then they have the moisture issue because they would have a snowpack. It's the Yukon, and they're doing a valley fill, infill heap leach. And so I think the combination of all that probably put that heap leach pad at risk. And then the marginality of the grade, the issue with the inventory, the working inventory there that they had a lot in hundreds of millions in inventory that was sitting on the heap leach pad that wasn't coming out, made their working capital position a bit more tenuous, that it probably is not current, that they're going to get it in 12 months. It's probably going to come out later. So financially, they had the debt of 300 something million. They were on the edge, the grades on the edge, and then you have this high risk leach pad. So it was set up basically that if something happened, you didn't have much of a cushion. And now you have, basically that mine that was built has now generated repercussions on the industry, especially in the Yukon, to do this kind of a processing in those conditions with the First Nations. And so other people are going to be hearing about this. The reclamation costs when you build a mine are going to go up. And so, the question is now that we really need to be better at this, such that we can't afford a lot of accidents, because those accidents and the news of the accidents have a bigger repercussion on the industry and what we can do than the ones that are good, that do everything right. Nobody ever talks about those, and nobody lauds them, and those don't get publicized, and you don't see that in the front page of the Northern Miner.
Joe, is there anything to those that say, hey, if we do mining today, like when the environmentalists point out you're changing the environment, you're harming the environment, and then one of the arguments back would be, okay, compare mining today to 50 years ago, even in the States or so-called first world nations, and it's so much safer and better for the environment now than it used to be. So don't you think we should still point that out even when we have the issues?
Yeah, these accidents, they've happened. But there's one, and then we don't see another one for 6 to 12 months, if at all. But that's almost 3 to 6 months of news. So it's like this accident's happening every day, because that's all we're talking about. And maybe rightfully so, but there's a lot of volume of news that operations are operating perfectly well that we're not talking about, and nobody cares about. At least that media side doesn't care about. So in terms of weight, obviously, the weight is in all the bad stuff, because that's what the media loves. They love the bad stuff because in the end, we're their audience and we love hearing about the bad stuff. So that's where they get the clicks, and they get, whenever, the readership and blah, blah, blah. Hey, this company did a really good job. They blah, blah. No, nobody cares. The investor is happy, but nobody's going to read that. So I think volumetrically, the news is much better than it is for these few mistakes. But the mistakes are the ones that we get talked about, and then those are the ones that set policy. It's not like, all these mines did a much better job on their geotech and could, do steeper open pits. Let's ease our open pit geotech on this because they're so good at it. No, you never see that. But you do see, the tailings broke. Okay, everyone's got to do this now. This heap leach pad failure. Okay, everyone's got to do that. But now the First Nations groups are now saying, okay, I want a moratorium on everything in my region because I don't know who to trust. Because now, at least in the Yukon, not only don't they trust the companies, but they don't even trust the government the territorial government, because they permitted that project. So yeah, there's big trust issues right now that'll have that'll resonate through that part of the world.
Do you think it'll go beyond the Yukon, the effects of this?
It could get into BC pretty easy because BC's also got its own issues with, the Supreme Court case in September that told the BC government they had 18 months to modify, reform, let's say, the Mineral Tenure Act. That due date comes in March 2025. And so that's incorporating them signing into the United Nations Declaration of Rights of Indigenous Peoples. So this is the pre-consultation. And so the battle will be, online staking, which you're not consulting anybody to take that ground. Do you have to consult them before? So how does that system work? That I could put a pending claim, maybe, then I talk to them, and then I get the claim. Nobody can stake out underneath me. I don't know how it's going to work. But also, what we got to know is that once you do stake the claim, I mean, the one that's doing the most work with the First Nations, gaining the social license operator and access, is that junior mining company. And if they have very poor social license to operate, it doesn't matter. If they got the claim, they won't get access. And so it behooves them to do it. So I don't think a lot of these companies that want to do anything in British Columbia or the Yukon and most parts of Canada, if not all of Canada, if they don't have good relationships with the First Nation, they're not going to get a project done. And they're also going to make it worse for a potential takeout because all those bad relationships are adopted with the new company, that they have to work around. And so, that social license to operate with the First Nations is critical no matter what. So it's not like we're inventing this in the industry. It already exists, but now you're asking for it to exist before I stake the claim.
Would that create kind of like an under the table bidding war between the tribal chiefs and various companies? Because I listened to the Gold podcast, the Gold Scam podcast, the BBC did on Bre-X. There was... Well,
that's a nice one, eh? That's a nice one. Why are you listening to that? Because that's a big negative. Okay?
That's true.
Yeah.
But there's a lot of behind the scenes, right, between government and private entities.
Podcast.
Yeah.
It was a great, because I listened to it, and this is after, I was in the industry in 97, but in Argentina, and I read the two books that came out at the time. But now that moratorium on these guys talking about it has basically been lifted. And so a lot of what the book had or didn't have, this podcast has. About all the ins and outs, and you understand more and people are talking more about it than they did then.
Mm-hmm. When you look at our industry, are there any financing or juniors that have financed either into production or just did a good financing that you could applaud or point out?
Yeah, I mean, I think the one that Montage did, Montage Gold, I don't own shares of that one. It's in West Africa, Cote d'Ivoire, which is probably one of the better jurisdictions in West Africa, if not the best. They've had it's a low grade. It's I think life of mine is 0.6 or 0.7. It's milling, so that's not really great with 0.6, 0.7, but the first few years, I think, get up to 0.9 or 1. And they have great recovery. And West Africa, those sort of places are easy to permit, easy to get into construction, and easy to start up. And they did, I believe it's 180 million, which is a lot of money in terms of a private placement. And they got Zijin Mining and the Lundin Trust to come in on that. And it was oversubscribed, so it was good. So that kind of financing, almost at market, it was like a slight discount to the previous close with no warrants issued, which is great. For those people that want to buy in the market, it's even better, because, they could buy in the market knowing everybody's in at almost the same price. That was a good one. And then, Sol Gold, Ecuador, big jurisdictional risk. They did, I think it was a $600 million deal with Cisco and Franco, $100 million upfront, to help them get to a feasibility study on their Cascabel project. It was a big porphyry copper gold project. But I mean, in terms of in situ revenue for the gold part, which the stream is on 20% of that, up to 700,000 ounces. And then I think it goes down to 12% life of mine on a 38 potential year mine life. So this is the kind of thing the streamers like. It's not a byproduct. So usually what you like is to do a stream on the byproduct. But so the way I look at a byproduct, if the in situ revenue of that of that metal is less than 10%, then I consider it a byproduct. I think gold for them might be over 30. So it's more like a co-product. And so it will hit them on the costs because they use that gold as a byproduct, and so now because the price is fixed for 20%, they'll take a hit on the cost. But in terms of financing, for them being in Ecuador to raise, I don't know, $1.5–2 billion to build the project and then fund it with equity right now to basically just get to the feasibility study, financing that through the market right now would be extremely dilutive. So this is dilutive in terms of, giving away part of the asset. But in terms of the denominator, they didn't issue any shares, which was probably good.
Are you speculating on any potential Trump trades if President Trump is reelected? What that would mean for the mining industry? We've talked about Trilogy Metals, former show sponsor, and that was a former pick in your newsletter. Their road permit was issued and then taken away from them under the Biden administration. Any speculation around the presidential election?
Yeah, it's hard for me to speculate, one nut job to the other nut job and just say, well, what's this idiot going to do? Or what's that moron going to do? It's all political. And I don't know. So all the science behind this works, this makes sense, is out the window. We can't run projects or development timelines with one administration saying yay, and then 4 years later, them saying nay. So for me, with that road, and now some of the First Nation groups that are on that road are pulling their support away, basically jumping on the bandwagon, or it's going to be hard. It's going to continue to be hard. Like Pebble won't work in any administration, so there are projects like that. And so if you have to move in the U.S., which has a fairly decent endowment of critical minerals and gold, if you have to move to be on private land to basically get permitted, to avoid federal permitting and, make sure that you don't have any of the waters of the United States on your property, that becomes problematic. So you're looking, okay, here's this great belt of rock. I can take this because I can consolidate enough private ground to actually build something. That one's a really great anomaly. That's even a better deposit, but it'll never get permitted. Okay, let's stick to this. And so that is a way of filtering that companies do right now. They'll do that in Indonesia with the contract of work. Now they're doing that, obviously, in the States with private versus public ground. In Mexico, they do the same thing.
So you're in Idaho. If you have to deal with the Forestry Service, you're walking away. Or if you're in Nevada and you have to deal with the BLM, the Bureau of Land Management, you're walking away. You won't even touch a company like that?
Well, Forestry Service with BLM, each office is different. So if it's a bad office, it doesn't matter if it's BLM or U.S. Forest Service, it's not a good area because they might be more, led by the people that don't want mining, and they have to go out and shop with these people. They go to the grocery store, they go to the bar and blah, 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 and they see them every day. And so if the influence is, when you get that mine permit, you might feel a bit of pressure. If the pressure is, don't permit that thing, you live with these people. So there are that human sort of issues with these offices. Now, the problem is that the governments, usually state governments that are Republican, are usually pro-mining. And so they try to make these projects work where they can. But if you don't have the social license to operate, they can't create it. So if you take someplace like Argentina, the land, the rights of the natural resources, is owned by the provinces. The federal government can create a positive environment for foreign direct investment or a negative environment for foreign direct investment, but it can't change your ability to permit a project in that province. So now the federal government of Argentina has made their policies to, accept foreign direct investment for projects over 200 million. Basically much better, lower tax rate, no duties after 2 years. Now you can repatriate funds. So the regime is better now federally. So, but you still have to be in the best provinces. And I think that's the case everywhere. You still have to be in the places that you can build. And then once you get in the places to build, yeah, you have that federal infrastructure of taxes, royalties, what have you. But that filtering is much more important now than it's ever been. And then you got to layer on the water issue. You know, if you have water, but it's potable and you got to compete, you can't compete. You got to find another way of getting water. So all that works into the permitting, you know, and the S&P Global Market Intelligence came out with this survey about permitting. And then, you know, Zambia was the worst. You know, I mean, there's not a lot. It's not like there's huge amounts of development projects that are going in this, but in terms of the data they have, you know, from discovery, let's say, to development, and there's a lot of quirks with the survey. Some of that delay might be something else that's got nothing to do with permitting, but let's just say, soup to nuts, you know, it's over 30 years for the states right now, and the states was second. And I know of projects, so you know, anecdotally, I can accept that number. Because, you know, I've looked at projects like Resolution, you know, they were discovered in the 90s. We're still not in production as 2024. You know, we could talk about, you know, trying to permit stuff in Minnesota near the boundary waters. We just talked about stuff in Alaska. So these sort of projects, you know, they have a hard time getting permitted, you know, and that's the stage they're at. You know, with a Trump administration, would some of those get permitted? Yeah, maybe some of the ones that have that federal block, that the state wants it, but the federal government is stopping it. That could change. But the problem is in 4 years more, you know, and you're not even in construction yet, they could take it away. So the underlying risk hasn't really gone away.
It's a good point. And you look at all this, when you're looking at an early stage project, you're already thinking about the red flags down the road, aren't you? You're not going to just say,
I want it to get taken out.
Right.
So if I'm going to get taken out, all the questions I'm asking is the questions the suitor would be asking. You know, because they don't want to buy a project that'll never get built. They don't want to buy a project that has really weak or bad negative social license to operate. If their comparative advantage is social license to operate and they think that they could heal all the wounds and develop the project, that's one thing. But most companies aren't like that. They don't want to go into a you know, expletive storm. They would much rather have everything done for them, because then they take the reputational risk, because all that negativity they get now. You know, and no company wants to reduce their increase their reputational risk, because they're probably permitting a project somewhere else. And suddenly they'll point to this one. They go, well, no, that wasn't me. We bought it, but we're trying to improve it. But, I heard that you're having problems. So they don't want to be associated with that. So yes, when you do look at a project, we look at projects, all that stuff comes into it, because those are the red flags that'll, you know, because we've got to deal with so many companies. We need to get filtering that quickly. And that's one of the filters is, can it ever happen?
Joe, my next question is about the efficient market theory and how it applies to the junior mining sector. We know the sector is cyclical, so it goes from too hated to too loved. But now with the advent of artificial intelligence, machine learning, a proliferation of mining media, and CEOs and companies being able to access investors and speak to them directly over the internet, whereas you couldn't do that even 20 years ago. Like, do you think that the markets are more efficient even amidst the cycles?
I mean, there's more talk. Whether that talk translates to data that can be translated into information that's useful would be the question. Because if you're just saying the same thing and it's nonsensical, it doesn't matter if I hear it from these guys or those guys or hear it in a report. I don't know if it's any more efficient. If people buy it and get fed this, untruth or stretching of truth, then if they get hit by five waves, they might think, oh, this must be good because everyone's talking about it, but it might be the reverse. They're just paying a lot of money for it and getting their name out. And you might not hear of a company that doesn't want to spend their money on that and just wants to put their money on the ground that you never hear about. Or you might hear about from one source, but you're thinking, oh, I'd like 2 or 3 different sources to get me a little bit of triangulation. But, that may not happen. So yeah, I'm not in complete agreement that it's efficient. If I was assuming the underlying data was good and everybody was not stretching the truth, then yes, efficiency would apply. But once you bring the human element out, it's hard to make a capital market efficient. And so for me, because we've got way too many conferences. Everybody's saying the same thing every 2 months. There's not much progress. It's all the same points. It's almost like politicians, everyone gets a point and you can watch 5 different channels and they all say the same thing. And you can repeat that same point that everybody's saying, whether it's their VP of exploration, whether it's their CEO, whether it's their chairman, and whether it's on this channel, that channel, or this podcast or whatever. And then you got to worry about, well, who's paying these people? Well, it's them. Okay, so should I listen to it? Probably not. So that's the other thing, is that for me, that's newspapers, that's anything. Now I don't read anything if I know there's an inherent bias. If I know what they're going to say before I read the article, I'm not going to read the article. Because I already know what their bent is going to be. But that neutral sort of, they might say anything, is what I want to read. I don't necessarily want to read the negative on the positive, but I want to read the neutral person to see what they would say, because I like their approach. That's what you really got to buy into.
And computers are writing a lot of these articles too. It's machine learning.
We use we use machine learning for grammar. In terms of, I use that same word 3 times, or, this would be a better sentence and you accept it, or this is a better spelling. We do use that. But the problem is that it changes the tone of the letter. And that's what I come back from, because I write the letter, because I'm not putting my name on anything and having somebody else write it, whether it's a machine or a person. I know in the brokerage industry, some people would cover like 40 companies or more, and they would have other people writing their notes. And when people would tell them, you made a mistake here. Oh, that was my associate. Well, don't you read this stuff? Because it's got your name on it. Yeah, so if it's got my name on it, I've read it and I've written it. If it's not got my name on it, I got nothing to do with it. And if somebody wants to write something and they want to quote me, I want to see my quote. So I'm very, worried or concerned, protective about my reputation. And so that's what drives me, because, you build this up, it takes it easy like a heap leach pad to get destroyed. So what you want to do is make sure it's sound geotechnically. And when you build upon it, you're building it on solid layers. And that's why people tell you things. That's why people reach out to you. They're not looking at you and saying, how much do I have to pay this guy? I just want to hear it. And if it works, let's talk. But if it doesn't work, it doesn't work. You're not paying me, and I don't want you to pay me. So when you read something or learn something, know the audience. Know the source of the information, who's paying whom. Even with media like the Northern Miner, Mining Journal, that a lot of the data articles are sponsored now. So even that is not independent. Just get your data and make sure, if you just want the facts, go to Reuters or go to Bloomberg or somebody like that. That's not giving you an opinion. Formulate your own opinion. But then when you want an opinion, then you want to trust where the source of that opinion is coming from, and are they getting paid to give you that opinion?
Joe, when I was studying AI, my wife, one of her college majors was English major. And so I have a small business not related to this podcast. And Google kept on saying, use Google Gemini, use Google Gemini. And so I was paying my kids to write these blog articles to get the SEO up on our company website. And then I said, I'm just going to try this. So I signed up for Google Gemini, which is Google's AI.
Yeah.
And it would punch out these blog articles that were taking my kids like 8 hours. And I said to my wife, I said, why would I even do that? Especially if it's the Google SEO. So then I punched out like 30 blog articles using Google Gemini in like 2 days.
20 minutes, yeah.
Exactly. But one of the things that was missing, though, was the human element of an opinion. So you're talking about the bias of opinion. It was like perfunctory. It did kind of lack a soul in some ways. So I would always try to add in some element of an opinion to it to make it more interesting to the reader. And also because that's what was lacking. So I guess this goes back to our earlier conversation when we were talking about machine learning. Like machine learning, apart from the human experience and the human intellect, ultimately, would you say that is what gives you, let's say, your competitive advantage, is all your experience, even being able to critique whatever the information that the machine learning tells you about a given resource and your network and the deal flow you see? Like, we'll never get away from that.
Well, I'm hoping not, but
otherwise you'll be out of a job.
I'll be out of a job. But what you think about is that, you got to teach the machine so many different things and find out how they correlate or they don't correlate. And that might take the machine a long time to actually learn and to get right and not make a mistake, because it'll make mistakes. The problem is that when you teach a machine and then you say, okay, drive the car, and then suddenly the machine doesn't know what an apple is and brakes in the middle of a highway because it thinks it's a human. And you go, well, no, that's an apple. But you never told me that. I didn't think that was a problem, because the machine is a baby. It doesn't know anything. So it only knows what you tell it. But it can go through reams of data much quicker than you could ever think about. So here's an example of what you did. So a company was coming out with something. I can't remember what it was. And I had to write a paragraph for a conference I was going to about, why I like the company and why I have it in my portfolio. So I wrote this portfolio because I don't like to be sort of very salesmanish, and that's not me. So I took that paragraph, put it into ChatGPT, said, okay, here's this paragraph. Make it more, selling. Make it more flower or whatever I use. And then it just came up with this stuff and it went, holy cow. And then I took that paragraph, sent it to the CEO, and he goes, wow. He goes, that's great. We were thinking about having a campaign. That's a great way to frame it. And I said, I didn't write it. It was ChatGPT, because I can never write that. I mean, because, it's just not my personality. But you could give it a personality. You could tell it, write it stale, write it from the, as if you were a 6-year-old girl, that sort of thing. And it'll change the language, make spelling mistakes, do all that sort of stuff. So it's getting very good at that. But the problem is when you write an article that might be 4 pages, it's got to read the whole thing. And putting it paragraph to paragraph, it'll lose the link between articles, paragraphs. There won't be a flow. I will never use it to write. I will use it to correct grammar, spelling, and stuff like that. But yeah, not write, because that's not what my audience is paying for.
Yeah. Well, your website is ExplorationInsights.com. Go over there, check it out. Joe has a bunch of free resources, and if you're interested in his paid newsletter, you can find more information there. Always great to chat with you, Joe. Really appreciate your time, and I'll reach back out to you in a few months to have you back on the show.
Great. Maybe we'll see you at the Precious Metals Summit.
I'll see you in Beaver Creek. Yep.
All right, man. Thank you.
Thank you.